Guys, to everybody who has been waiting patiently for my next podcast. I know last week I went the entire week without doing a podcast, which is unusual. But if you are a regular listener to this podcast, you'll know that I was on a cruise ship all last week. I was on the Real Estate Guys cruise. The internet connections on a ship are very slow, particularly the upload speeds. Plus, I was very busy, so I really decided to take a week off from podcasting. And there really wasn't that much that happened last week. The markets were overall quiet, although the U.S. stock market rallied. Gold didn't do much. The dollar didn't do much. No real earth-shattering news. So I didn't see any reason why I couldn't wait till I was back on shore, which is what I'm doing. And in fact, I was so busy today that it's very late on a Monday night, and I'm just trying to get this podcast recorded today. First of all, I'll talk about some of the stuff that happened last week. We did get the release of the FOMC minutes that came out. And in fact, after the minutes came out, we had a pretty big drop in the price of gold. Gold did manage to get all the way up, I think, to about 1365-ish during the week before selling off. And I think the Fed minutes were a catalyst to get gold to sell off. Of course, it can't sell off very much, really can't get much below 1330. There is a lot of buying that comes in down there. The read on the minutes were that they were hawkish in that the Fed was signaling that it thinks the economy is going to keep strengthening and inflation is going to keep rising. Well, at least they're half right, because the economy isn't going to keep strengthening, but inflation will keep rising. And in fact, they're not even half right, because they're right that inflation is going to go up, but it's going to go up by a lot more than they think. So even the part they got right, they really got wrong. And we did get some inflation numbers, official measures of inflation that the government released last week. And if you look particularly at the producer price index, you jumped up. I think core producer prices rose at the fastest pace in about 7 years. And if you look at a chart, we're very close to a breakout of resistance on core PPI. Core CPI also up, I think, a little better than expected. But this is just the beginning of a trend. In fact, during the week, oil price had made new highs. We got above $67 a barrel. So we're continuing to get closer and closer to 70, then eventually 80 and 100. And it's not just oil prices that are rising. It's pretty much prices across the board for commodities that are going to be rising. But the Fed is not going to be able to deliver the rate hikes that the market is expecting. And again, it's the expectation of more rate hikes that is what is keeping a lid on the price of gold. But it's only a matter of time before the market blows the lid off and the price of gold goes up. In fact, gold prices were relatively flat today. We're just below 1350. The last I checked, we're 1347. So not much movement in the price of gold, but it looks to me like we're continuing to trade sideways in anticipation or in advance of a breakout. The same thing happening with the dollar in the other direction. The dollar continues to be weak, although it is not breaking down, but it is not recovering any of its losses. The dollar index again today closing below 89.50. So on the weaker end of where it's been, just biding its time, waiting for another decline. In fact, even though the FOMC had a rosy assessment of the outlook for the economy, the Atlanta Fed twice, reduced its estimates for Q1 GDP. Last week they went down to 2%, and then today they went down to 1.9. So here we are again, back below 2% for the official estimate for first quarter GDP. And you got to believe that Q1 is probably the high watermark for the year, that Q2 is going to be weaker than whatever the number is for Q1, because Q1 had all the hype in it, all the anticipation of the tax cuts, the big build in inventory. Despite all of that, we're barely getting any growth in Q1. And I think because we had to pull growth forward from Q2 in order to get a pathetic 1.9 or wherever it's going to be for Q1, then Q2 is going to be a lot lower because we've pulled that growth forward. And that just blows up this whole bullish scenario of 4 or 5% economic growth. And remember, it was the strong economic growth that was going to make up for the added deficits that were created by the tax cuts. Well, if the growth doesn't materialize, then not only will the deficits, be bigger, but they're going to be much bigger than anybody imagines. In fact, while I was away, I noticed an article that pointed out that the deficit had been $600 billion for the last 6 months. $600 billion in new debt in the last 6 months. We are now borrowing $100 billion per month. That is a $1.2 trillion run rate for deficit spending. Now, of course, whatever we spent in the last 6 months, we're going to spend more in the next 6 months because of the effect of rising interest rates. As more of the bonds mature during the next 6 months, they're going to have to be rolled over at even higher rates than what we got rolling them over in the prior 6 months. Plus, you've got the increased government spending, you got the tax cuts. So who knows? I mean, maybe the next 6 months, it won't be $600 billion, but $800 billion. And of course, if we end up in recession, we could spend $1 trillion in the next 6 months. Who knows how much we're going to do? So these deficits are blowing through the roof. And this is going to be the driving force in moving the dollar substantially lower and moving gold substantially higher. In fact, we got some more economic news today on retail sales. Remember, retail sales had dropped for 3 consecutive months. So it would have been maybe unprecedented for retail sales to have been down again. But we got the March retail sale number, and it was actually up more than expected, up 0.6 tenths of a percent. They were looking for 0.4. But if you back out autos and gasoline, instead of being up 0.5, which was the expectation, we were only up 0.3. And so what that tells you is that consumers are spending more money on gas. Now, they're not spending more money on gas because they're driving more. They're probably spending more money on gas because gas is more expensive. And so if expensive gas is the reason that retail sales are rising, that ain't good news, right? Unless you're selling the gas, right? Unless you're in the oil business, the fact that it's costing Americans more to fill up their tank is not a good thing for the economy. And I expect that to continue. But ultimately, as consumers are putting more money into their gas tank, they're going to be putting less money someplace else. So what we spend on gas, we can't spend on other things. And it's the people who are selling other things that are going to suffer. And, we have a lot more people employed in industries that sell things other than gas. So ultimately, higher energy prices are going to be a drain on most consumers. Obviously, not all consumers, but most consumers. And I bet, again, we're going to go back to weakening numbers in the future. After all, after 3 negative months, we're bound to have another one. And again, who knows what we're going to have? I mean, they might revise this number lower when we get the revisions. But, probably the biggest news of last week, other than the fact, almost forgot, that we sent cruise missiles into Syria, right? I mean, although the market rallied today, the Dow was up better than 200 points, although we did close just over 100 points from the high. I wonder if the market rallied just based on the relief that, whatever we did in Syria, we didn't do more, that it was kind of like a minimal response. I mean, we knew that something was coming, and the fact that what came wasn't as bad as maybe people thought it might have been. Maybe there was some kind of relief rally there in the market. But apart from the fact that we were, bombing Syria, the most important news, I think, that came out of the week was the announcement by House Speaker Paul Ryan that he would be resigning his House seat at the end of his term, right, which ends, this year. Now, this is big news as far as I'm concerned, because the question is, why would he decide to resign? I mean, he's the Speaker of the House of Representatives. I mean, that is technically the 3rd highest office in the land, right? Because if the vice president and the president both die, the Speaker becomes president. So you're number 3, right? You're 2 heartbeats away from the White House. It's a very powerful, prestigious job. why would Paul Ryan resign? And the most likely reason is that he thinks he's going to lose the job anyway, right? I think if he believed that the Republicans were going to retain control of the House of Representatives, he would stay. But obviously, he wants to distance himself from the loss, right? He doesn't want to be the guy who loses the House of Representatives, especially if he has, a bigger career in mind. I mean, you have to believe that Ryan may want to be president someday. He may want to run for president, and he may not want to be associated with the loss of the congressional majority to the Democrats. So maybe by resigning and now letting some other guy become speaker, and now that guy loses the House, well, it's not Ryan's fault, right? Somebody else blew it, right? He's kind of abandoning a sinking ship before it sinks. And that is consistent with what I've been thinking is going to happen all along, that the Republicans are going to lose control of Congress. But even beyond that, even if the Republicans don't lose control of Congress this year, they'll probably lose it in 2020 when they lose the White House. And maybe Ryan doesn't want to be associated with that loss either. Maybe he wants to distance himself from the problems that he sees coming, not only in the Republican Party, but in the country, knowing that all those problems are going to be blamed on the Republican Party. And if he is the Speaker of the House, if he is leading the Republican Party at that time, then obviously the blame is going to fall heavily on him. So what he wants to do is put a lot of distance between himself and that disaster. And by resigning now and not seeking re-election, he can go away from Washington, allow everything to happen, right? All the bad stuff to happen, allow everything to collapse, and then come back fresh, maybe not even in 2020, maybe he's thinking 2024 or something. He's still a young guy. He can come back in the future and say, hey, I'm the outsider. Hey, let me clean this mess up, because obviously he has high name recognition, right? He was the Speaker, so he's got a good resume. He just needs to get away from a while, right? Get out of Dodge, get out of town, do some other things to keep his name in the paper, but to disassociate himself from what's going on in Washington now and what's likely to go on in the future. And I think people are downplaying the significance of that resignation and that political move. But to me, it really speaks volumes and validates what I've been saying regarding my fears of the loss of the Republican majority in Congress and then the loss of the White House. Another thing that happened while I was on my cruise was a big rally in Bitcoin, right? Bitcoin, which had been trading below 7,000. I mean, it didn't quite, I don't think it ever broke 6,500, at least on the exchange I was looking at. But then all of a sudden, one day, it spiked from about 7,000 to 8,000. I think it got as high as 8,500 maybe, but that $1,000 spike took place, about 5 or 10 minutes. I mean, 15% move in 5 or 10 minutes. I mean, what market moves that much, that quickly? I mean, I know everybody wants to talk about, the gold market is manipulated. Maybe it is, maybe it's not. But clearly, the Bitcoin market is manipulated, because there's no other explanation for that bigger rise in that short of time other than manipulation. I mean, it's no way that somebody all of a sudden decided they had to buy all those Bitcoins in a 5 or 10 minute window, right? I mean, the volume had been pretty thin. The price action had been pretty weak. If I legitimately wanted to buy a bunch of Bitcoin, I could have bought them, and I could have just been a little bit more patient. And instead of buying all the Bitcoins I wanted in 5 or 10 minutes, I could have spread my buys out over a few hours or maybe even a few days, and I would have got a much better price, right? I wouldn't have had to run the price up to 8,000 and change when it was trading at 7,000. So to me, the reason that the buying took place was to drive the price higher. That was the goal. Maybe they waited for a time where the market looked thin, where there weren't a lot of offers, and then they ran in, and who knows how many individuals were involved. My guess is there were several people that coordinated and decided we're going to try, and maybe they're buying and selling to each other. Who knows what they're doing, right, to get the market to move higher. But that was their goal, right? They wanted to kind of get a higher price just to kind of create some kind of excitement, some kind of enthusiasm, get people to think, aha, there's a bottom, you got to buy, it's going to go even higher. Hey, it could jump another $1,000 a coin in the next 5 or 10 minutes. It just smells completely like a manipulated market to me. I seriously doubt that this rally is going to last because they're not going to be able to continuously manipulate the price higher when ultimately the goal of everybody who's manipulating, and I'm convinced of that, the goal is to get out, right? That's why they want the price higher. They want the price higher so they can sell. And so they have to generate more buying. And I'm not sure how much they had to buy in order to get the price higher. Sometimes, if you're playing poker, you have to lose a few hands in order to win big, right? So this could be part of the strategy. Okay, we'll buy a little. And of course, they're on paper, they're ahead on some of their buys. Some of the buys they made at 7,100, 7,200, 7,300. If we're at 8,000, they're ahead there. They may be behind on what they bought at 8,400, 8,500, whatever, but they may still have a small gain. But of course, now they have to unload those coins to actually have a real gain, right? And I think they're in the process of doing that, right? But they're hoping that by bidding up the price so quickly, they'll bring some new buyers, into the game so that they can unload even more. So I don't think there was anything significant about that rally. To me, it's still a bear market rally. And I think the same thing is going on with the stock market. Yeah, the stock market has rallied a little bit. The Dow is back above 24,000. But to me, the rallies, again, looks like a bear market rally. Now, technically, yes, we're not in a bear market yet because we haven't dropped 20%, although many, many stocks individually are clearly in bear markets based on how much they've fallen. But the market overall technically is still not in a bear market. But again, as I've said, if ultimately we're down 20, 30%, then it's a bear market right now. We're just too early in the bear market to know that we're in a bear market. Just like, we're not in a recession until we have 2 consecutive quarters of negative GDP growth. So in the first month of a recession, you're not in a recession yet because we haven't had 6 consecutive months. But if it turns out that we have 6 consecutive months, then the first month was a recession. It's just that nobody acknowledged it because officially it wasn't a recession. So no one is acknowledging this bear market yet because officially we're not in one. And I still think the only way we avoid one is if the Fed comes in and completely does a 180. They're going to have to go from hiking rates to cutting rates. They're going to have to go from we're going to shrink our balance sheet to we're doing QE4. That's what the Fed is going to have to do to prevent a bear market. Now, they may end up doing it in response to a bear market, trying to prevent the bear market from getting any worse, right? It all depends on how long the Fed can hold out in this gigantic game of chicken. And as far as I'm concerned, it doesn't really matter. I just know eventually, they're going to blink. They're going to have to, especially when you got the politics. You've got this election, right, in November, and they're going to do everything they can to try to, put as much lipstick on this pig of an economy leading up to that election. And again, if I'm right on what's going to happen, and we end up with the Democrats taking over, the first thing they're going to do in the new year, in 2019, is they're going to pass a massive make-work infrastructure stimulus-type bill that Donald Trump is going to have to sign. And especially if the economy is in a recession at the time he is given a stimulus bill to sign, there's no way he's going to veto it, especially since he signed the stimulus that the Republicans passed, which was tax cuts for the rich. How can he be against all this spending for the poor and the middle class? And he's not going to be able to say, well, we can't do it because it's going to blow a hole in the deficit, because he doesn't care about the deficit. He didn't care about it under Republican Congress, so why should he care about it under a Democratic Congress? He won't. So we are, in the perfect storm, I think, of massive explosion in deficits, not just the budget deficits, but the trade deficits. These tariffs or a trade war is only going to compound the problem. We've got the economy weakening, and we've got the dollar teetering on the brink of collapse. We've got gold about to break out, and the bond market is in the same thing, right? The bond market, we had a big spike up in yields, and now we're just kind of going sideways. The 3 major markets, bonds, gold, and the dollar, are all moving sideways. getting ready to continue their most recent moves, which for gold is up, for the dollar is down, and for bonds are down, which means interest rates are up. And it's 1, 2, 3 strikes, you're out. Now, another thing too that is still frustrating a bit is, while I was on the cruise, I get some emails, and again today, we still have a lot of Euro Pacific capital investors throwing in the towel, right? Closing their accounts. Now, I'm happy to report we're getting a larger number of new accounts. So there are people now who are thinking right? And we are still having people adding to their accounts, but it is really frustrating to me to see so many people when all the evidence is so abundantly clear that everything that we've been planning on and everything we've been positioning for over the past several years, when it's so obvious from the economic fundamentals. I mean, forget about looking at the markets. The markets are going to fall in line. But you look at what's going on in the big picture, looking at what's about to happen, right? You can't conclude anything other than the fact that this strategy is going to pay off big. But, I wanted to talk about one conversation I had today in particular with a client who was closing his account, who was a broker for 25 years. That's what he did for a living. In fact, he even worked at Lehman Brothers, which is a firm I worked at, so I don't think we worked there at the same time. But 25 years, this guy was a stockbroker. And so he has an account with me, and he let his representative know that, he was going to be closing his account because over the last 5 years, he hasn't been happy with the performance, and so he's closing his account. And so I gave the guy a call, but I happened to notice that he had 2 accounts with us. He had this one wrap account that I've been managing in my mutual funds, and he had another account that only had U.S. stocks in it, about, maybe 10 or so different U.S. stocks. I'm sure that they were all stocks that he picked himself. And I'm not sure if we bought them for him or if he transferred them in, but he had an account that had all U.S. stocks. And of course, the account was up, right? That account was positive. His account with me was slightly down. So he was doing better, certainly in his U.S. portfolio. But I took a look at both accounts starting in January of 2016. And it turns out that over that period of time, the account I was managing was beating the account he was managing in U.S. stocks by 40% more gains, right? As a percent. I forget what the two were. Not that it was up an additional 40%, but let's say his own account was up 10% and my account was up 14%. That 4% would be 40% more than 10%. Those aren't the numbers. The numbers were actually much higher for both accounts, but I'm just, illustrating this point. So I noticed that my account was doing, the one I was managing, was doing much better over the last 2 years, not the last 5 years, but just the last 2 years, than the account he was managing himself. And so, my thought was, hey, wait a minute, you're doing the wrong thing. Instead of, closing the account I'm managing, you should close the account you're managing yourself. Recognize that the trend has changed. Don't look at the last 5 years. Just look at the last 2 years, right? And so I had a conversation with this guy, but I couldn't convince him. He couldn't get past the fact that over the last 5 years, the returns weren't good. Even though they were very good, and he admitted that for the last 2 years, they weren't good for the past 5, and 5 years was his time horizon, that if you don't do a good job over 5 years, then, he closes the account. And, this is a guy who was a professional broker. This was his career. And if he can't see this, no wonder so many people who have never been in the industry are making the same market timing mistake. I tried to explain to this guy that during the 5 years he's had an account, for the first 4 of those 5 years, the dollar was going up, right? Gold was going down. Commodities were going down. He had a portfolio of foreign stocks, gold stocks, commodity stocks. How does he expect to make money in that portfolio during that environment? Only the last year, the only year the dollar went down during those 5 years was last year. That was it. Yet despite the fact that the dollar went up in 2016, his account still made money in 2016, and then it made money again in 2017. So I was trying to point out, hey, the situation has changed. Your account didn't do well during 5 years when the dollar was in a bull market, but how do you think the account's going to perform over the next 5 years if the dollar is in a bear market? Also, you were in the U.S. stock market over the past 5 years. That was a bull market. What if the next 5 years are a bear market? So if the next 5 years include a bear market in the dollar and a bear market in stocks, obviously the portfolio that I'm managing is going to do much better in that environment than the environment that we had over the last 5 years. But this guy couldn't figure this out. right? I could not, no matter how much I tried, I could not convince this guy. And believe me, I mean, I use all the logic that I could use. And at the end of the day, he couldn't hear anything that I had to say because he couldn't get over the fact that, yes, but over the last 5 years, and no matter how much gains potentially we could get in the following 5 years, none of that matters. And so to me, I mean, this guy is going to take the money that he had with me, and he's just going to buy more of the same U.S. stocks that he already owns. Now, here is the problem. His U.S. account right now has gains, right, because of the gains that he had over the past 5 years, even though over the past two, they haven't been as strong as what he would have had in my account. But my fear is that he's going to end up losing most, if not all, of those gains that he used to have in the U.S. stock market in the bear market. He's going to surrender the gains from the bull market in the bear market. And to the extent that he doesn't, to the extent that any of those gains are not lost, it's going to be completely a function of a weak dollar, right? Inflation is going to be so high, the dollar is going to be so weak that the U.S. stock market might not go down. But in terms of real purchasing power, it will collapse, right? Because the only way that the Fed can prevent or mitigate a bear market is by sacrificing the dollar in the process. But of course, if the Fed sacrifices the dollar, then the portfolio he currently has with me would take off. I mean, we would have massive gains in a dollar crisis. If the dollar were to lose a significant amount of its value, and the result of that would be a breakout in the price of gold, a big move in the price of commodities in general, a general movement of assets globally out of U.S. stocks into foreign stocks and emerging markets, those are all of the things that would drive